Hello, Finamisers. Welcome to another Finamise Live. My name's Russell, Global Analyst here at Finamise, and I'm happy to host today's event with our partner, State Street Investment Management. First, we have some housekeeping to run through. There's going to be a 15-minute discussion followed by a 15-minute Q&A. We'll use the chat box to tell you when it's Q&A time and add in some important links for you today. So please remember to keep an eye on it. Please use the Q&A box to ask a question, and if you see a question you like, upvote it so it moves to the top. That way we can get through the most upvoted questions first. Okay, so let's get started. Today's session is brought to you in partnership with State Street Investment Management. If you're not familiar with State Street, they draw from their global scale and market-tested expertise to help create original solutions and better outcomes for their clients and the world's investors. For more information on their full list of ETF products, market insights, investment ideas, and ETF education, you can visit them using the link in the chat, statestreet.com/investment-management. Now, of course, no finance event is complete without a quick disclaimer. Your capital is at risk. This isn't financial advice, and your tax treatment depends on your individual circumstances and may be subject to change. With that out of the way, I'm really pleased to introduce today's guest, Michael Ricks, Senior Strategist at State Street Investment Management. Michael serves as a subject matter expert in ETFs and portfolio construction. In this capacity, he performs economic and market research used to generate strategic and tactical investment opportunities across asset classes. Before this, he led a team responsible for attribution and analytical reporting for State Street's institutional clients, so he's no stranger to turning complex data into smart decisions. He holds an MBA from the University of Massachusetts Amherst and a Bachelor of Science degree from Bridgewater State College, as well as holding the CIMA designation. And yes, he's passed the dreaded Series 7 and 63. Safe to say you're in very good hands today. Michael, it's a real pleasure to have you with us. How are you doing?
Hello, Finamisers. Thanks for having me back. It's good to join this community. Great community.
Excellent. So let's dive in. On the screen, you should see a poll to kick things off. Please take a look, give a vote, and we'll look at the results before the Q&A. Okay, so Michael, why should I include mid-cap stocks in my investment portfolio?
Sure. I would say most investors, when building portfolios, tend to think about the extremes. So meaning they start with large caps, which is the proper way to go. Large caps tend to be the core of your portfolio. But then they immediately gravitate to small caps to get maybe more opportunistic opportunities or growth opportunities from that perspective. And they tend to miss the very middle. So we tend to make the analogy of investing like golf. So when you're golfing, if you're not owning mid caps, it's kind of like not owning the irons that are in your bag. You just kind of own a driver and a putter. But let's define what mid caps are. So mid caps, by S&P's definition, so S&P is the index provider of the S&P 400, which is the index for our mid cap ETF MDY. So mid caps typically we consider to be market capitalizations or market values between 8 billion and 22 billion. So a market cap or a market value is the amount of money you would need to buy that company outright overall. So north of 22 billion, we think of as large caps. South, we think of as small caps, but right in the middle, 8 to 22 billion, we think of mid caps. And mid caps really do offer a very compelling blend of growth potential and stability. So unlike small caps, which mid caps tend to be more established, they have stronger balance sheets. You're going to hear stronger balance sheets a lot when hearing a lot of financial talking heads. If you listen to CNBC or Bloomberg, let me tell you what that is. So a strong balance sheet typically means that a company will have many more assets than liabilities. So they'll have more assets than debt overall. They also tend to have a lot of cash on hand to meet short-term obligations. They're very well capitalized in terms of their debt and equity capitalization, the money that they raise to fund operations overall. So when we say strong balance sheets, it really means a company has lots of assets, plenty of liquidity on hand to meet any of its debt, et cetera. And mid caps tend to offer better balance sheets than a lot of the small cap companies do overall. So again, it's kind of blending the idea of um, good balance sheets, but with the potential for higher growth than large caps. And that's why you really should consider mid caps as part of your portfolio.
Okay, great. Yeah. And so how they performed, or mid-cap stocks perform historically compared to those small and large caps? Maybe sort of, I don't know what time horizon you'd like to think about there.
Yeah. If we think about the very long term, so, and I'll basically use the inception of our mid cap ETF MDY as the long term time period. So MDY was launched in 1995. It was the second ETF launched in the United States, and again, just focuses on mid cap companies. So since 1995, mid caps, as defined by the S&P 400, have actually outperformed large caps over that time. And I think that would surprise a lot of people because large caps have been very much front and center recently as very good, as the best performers overall. Short term, mid caps have outperformed small caps, but with much less volatility. So, again, I think what you're looking at here is longer term, the growth potential that small caps might offer, but the stability and good balance sheets that a lot of large cap companies offer. So, historically, terrific performers outperform large caps, over the last 30 years, we'll say, by almost 1% annually. So, since inception of our MDY, it's averaged about 11% return on an annual basis. So let's think about that. That's essentially $1,000 investment over that time period at 11% is almost 6 times your money. So a lot of folks think, oh, 11%, they're sometimes shooting for the moon, but investing is really a get rich slow game, we like to say. Uh, and mid caps have been a terrific performer, outperforming large caps in the long term, outperforming small caps in the shorter term, but really a sweet spot right in the middle.
Yeah, that's interesting. Sort of. So mid-cap stocks could be the market's hidden gems, sort of like from here in 26 and going forward, do you think? And I suppose tying into that, what conditions economically or market-wise are ideal for mid-caps to outperform?
Sure. Yeah, there are several factors supporting um, the idea that mid caps really could be hidden gems. Again, for the most part, it's been the large cap companies, the really mega cap names that have been on the minds of a lot of investors. The Nvidias of the world, Microsofts, Google, etc. These tend to be brand names that a lot of investors are aware of overall. But not so much mid caps. Mid caps don't tend to be these large brand names that we hear about overall. But there are some significant factors that we're seeing in the marketplace that could be very much catalysts for mid caps to perform well over the coming year and actually coming few years overall. The first is when we look at valuations, mid caps have a valuation advantage over large caps currently. So a valuation, typically what I'm talking about right now is what we call the PE ratio. So that's the price of a security divided by its earnings. You can think about the PE ratio as the number of years it's going to take to pay back your investment if the company or this asset class doesn't grow its earnings at all. So think about the PE ratio as really the amount of money it's going to take you to earn your money back through earnings for the price that you pay. Currently, large caps, the price to earnings ratio is north of 24, which is really almost the highest it's been in the last 25 years. So if we look over the last 10 years or so, it's significantly higher. We've averaged about 18 or 19 in terms of the PE ratio for the S&P 500. And today it's trading at 25. So that tells us that you're paying a lot for the earnings that you're getting overall. Mid caps, on the other hand, have a significant valuation advantage. So the PE on mid caps currently is right around 18 overall. So again, large caps trading at we call it a multiple of 25, which means roughly 25 years to get your money back through an investment in earnings. And right now, for small mid caps, it's about 18. So from a valuation point of view, mid caps are trading at much more reasonable earning multiples compared to large caps. Okay. On its own, valuation is not a good metric just to use on its own as an investment uh, variable. But in combination with earnings, it can be very powerful. So we just mentioned mid caps are trading at a more attractive valuation, but their expectations for earnings growth are actually higher than large caps over the next 3 to 5 years. So the estimate for the S&P 400, which is the index that underlines MDY, the earnings growth rate expectation is around 14% for the next 3 to 5 years. It's around 11.8% for the S&P 500. So again, better valuation and higher earnings growth rates. And if there's one lesson I can teach you, and you're going to probably hear me say this every time I talk to the Finnermizer community, earnings growth rates are what drives stocks higher. Earnings growth rates are the most important variable long term to why the stock market goes up. If we look at the last, let's call it 60 years, average earnings growth rates in the US equity market have been about 8%, and the price return has been about 8%. And so that's why it's so important that I tell you that the expectation is for mid caps, earnings growth rates will be reasonably higher than large caps. So about 14% over the next 3 to 5 years versus 11.8%. You combine that with valuation, and it's a powerful tailwind overall. Lastly, I would tell you some policy tailwinds. So deregulation and a pro-domestic agenda. Most mid-cap securities derive the majority of their revenue from U.S. sources. This would be very good if deregulation and the pro-domestic agenda starts to move forward. It certainly favors mid-sized firms over small and large cap firms, given the idea that mid caps tend to be a little bit more stable with better balance sheets. So that's why 2025 we're kind of excited for mid caps overall.
Excellent, really good answer. Thank you for that. Yeah, I suppose next one, sort of, what strategies should Finimize listeners use to uncover mid-cap US stocks with growth potential? Is there a screening, or sort of what's a good way to do it, or do you think ETFs are the best way forward?
Sure. Yeah. So if you're an individual stock picker, you have to figure out a universe. And I think one of the best universes for mid-cap stocks is the S&P 400 or the MDY holdings overall. So if you go to spiders.com or statestreet.com and you look up MDY, you will have the ability to look at all 400 holdings within the S&P Midcap Index. And that gives you kind of the universe of securities to start from. So that's one screen. Now, the benefit of this screen is it's already been pre-screened. So S&P, Standard & Poor's, has what is called a financial viability screen for the S&P 500, the S&P 600, and the S&P 400 indices. The financial viability screen is that a company must have positive earnings over the last year for it to get into the index. This is incredibly important in terms of if you're a stock picker, that the companies you are looking at actually earn money or have positive cash flow. That is one of the important to tell you in terms of investing. Too many investors get stuck in what seems to be great ideas of companies that make no money, and in some cases don't even have a product overall. You'll see this in a lot of quantum computing today, where there's actually a stock that's a quantum computing company. They don't even have a product. They don't have make any money whatsoever, and yet they have a very high valuation overall. So again, let's start from the top. First place to go to screen companies, take a look at statestreet.com, look up MDY and look at the holdings. You can download it. It will come right into Excel. Those are your 400 names to kind of start from. Those names have been pre-screened. So that means to get in, they've had positive earnings growth. It doesn't mean they currently do. There are some companies that can come in and out of favor, but at least they've been screened originally to get into the index for positive earnings. And then there are also some other screens in terms of liquidity overall. So again, a great place to start there. And then from there, absolutely have to look that they have either positive cash flow or positive earnings and earnings growth rates. Those are critical. There's just companies that are just too speculative. And while, there are some companies that go up 200 and 300%, it's really based on speculation. You want companies that are growing because they're growing their earnings and growing their revenue, right? And the best example of this would be NVIDIA. Sure, NVIDIA is up 3 or 4 times over the last 2 years, but it's up 3 or 4 times because its earnings, its revenue is up 3 or 4 times. So be wary of those companies that have doubled or tripled in value but make no money. Those are speculative investments. That's gambling. Investing is really looking at companies that are growing their earnings, growing their revenue, and that's those are the big 3 screens I would start with when looking to uncover stocks. The universe of mid-cap securities via the S&P 400 and MDY. Those have been pre-screened in terms of they have positive earnings, at least to get in to the index. And then your due diligence in terms of, are they growing earnings, or is this stock just on fire strictly because of speculation?
Excellent, thanks. Okay, so it's time to turn this over to you listeners here, all tuning in for the Q&A. And whilst we wait for the questions to come in, let's take a quick look at those poll results. Can we get those up, someone? Meanwhile, while we're waiting for that, here we go. So pretty balanced, yeah? But yes, generally. So you're talking to a pretty learned audience, which is always good to see, yeah? Let's kick off with that top question there. And please remember to upvote the questions you like if it gets busy on the chat. Is incorporating mid-caps into my portfolio going to require a more active management style on my part? I mean, how much more work is it when you start going to single stocks and I guess then mid-caps as well, yeah?
Sure. If you're going to start with an index or an ETF like MDY, you want to think about large caps kind of being the core. So if we look at the US equity universe, the US stock universe, it's roughly 90% large cap, 7% mid cap, and 3% small. So the starting point there would be around 7 to 10% of your portfolio could be in mid caps, and you would simply be following what the asset class looks like from a US point of view. You can look for active managers overall that have outperformed or that have an investment philosophy that you like. I've only warn you that long term, it's very difficult for an active manager to outperform over long periods of time. The data suggests that because active managers are competing against one another, there will be someone who outperforms. We just don't know who it is. So no, I don't think it needs to be an active component. It can be a strategic 7 and 10% of your holding. And then if you do think of some of the tailwinds that might be happening and you want to kind of actively manage your portfolio, such as, do we have moderate economic growth or at least positive economic growth? Do we have declining or stable interest rates? Is there a valuation gap? Then you can up your allocation to mid caps, given the idea that we do believe they would perform very well in those types of environments.
Okay, good. I sort of partly covered, but the next question coming in is, when it comes to building mid caps into my portfolio, is there a sense that this should be instead of or replacing my large cap or small cap holdings, or in addition to?
No, it should always be, in my opinion, it should be in addition to. So I mentioned the framework with which you could start. The US equity universe is roughly around 90% large cap, 7% mid, and 3% small. So that means you have 90%. You could start if you wanted to be um, look like the US equity market looks like. You could start with a 90% allocation to the S&P 500, 7% allocation to MDY or the S&P mid cap, and then a 3% allocation to small caps. And you would be looking just like the US equity marketplace. And then from there, you do your due diligence, right, to see just what we talked about. Are there valuation gaps? Are there declining interest rates? Do we have good economic growth on the horizon? And then you can add more to mid and small caps to be a little bit more bullish, or take away to be a little bit more bearish. But I don't think about them as replacements unless you're 100% large cap, or 100% small cap. Then yes, you should start to balance between the three asset classes.
Okay, good. The next question, I think, well, it was on my screen until it scrolled down. You kind of touched on it before because of the way that you screen for ideas, but is the S&P 400 ETF MDY, reliable? And I think I think you've kind of touched on it, but I'll let you answer it because, there's the question there.
Absolutely. I actually think it's probably one of the best mid-cap indices you can choose. And the reason for that is S&P defines exactly what a mid-cap company is. Again, really companies between market caps of 8 and 22 billion, and then has the financial viability screen, meaning in order to get into the index, you have to have positive earnings. So from there, that's a great start, right? You already know that it's a quality index to begin with. And then you can start to look at things like expense ratios, liquidity, how often it trades, what the costs are of trading it, et cetera. But I think the S&P 400 is a great place to start if you're looking to become a mid-cap investor. And it certainly has a great long-term track record.
Cool. Digging down into like a bit more someone's following up on one of your comments. Can you give an example or examples that suit the analysis that you mentioned? Yeah, S&P 400 member, positive cash flow, and growing earnings and revenues. So
Yeah.
looking.
So are you asking that question from perspective? How do you find that information overall?
I think
Or
it's more, can you give an example? The question sort of is from like one of the, one of the things. So yeah, I mean, I suppose he's like, and someone else kind of come with which are the mid caps with the highest potential for in the future, in your opinion? I think they're trying to drill down into the S&P 400 names and say which companies may be outside the ETF do you like of those, if you're kind of happy to talk about them.
so maybe not any one particular stock, but I will tell you that we do like financials within the mid cap space. So there are a couple of things going on. There are the idea of regulatory constraints currently around financials that restrict from operating in certain businesses that might be profitable, or for mergers and acquisitions. We do think there will be deregulation that does help as a tailwind for the financial sector of the S&P 400. So that's one. The other idea is the potential of stable coins to be another revenue source for financials overall. So that's the Genius bill that was passed recently is kind of a green light for banks to start potentially using stable coins overall, and that's kind of a tailwind overall. So while I don't have any individual one or two names to give you, I can tell you that it looks like financials look like an opportunistic area of the mid-cap space based on deregulation, the idea that interest rates are starting to come down. We have a steeper yield curve, which is beneficial for financials overall, and the potential use of new fintech technology such as stable coins can be tailwinds for the financial sector.
Okay, good, thanks. Next question coming in is, are there any interesting mid-cap ETFs across developing and emerging markets that you'd consider?
So, I love this question because there's actually isn't. In most cases, you will see really just large cap and small cap exchange traded funds in the marketplace. I don't tend to see a lot of international mid cap funds. I can tell you a website like etfdeck.com, which is run by FactSet, can be a place you can go and screen for mid-cap international ETFs themselves. But I don't know of any specific offhand. I don't think there's a lot overall. And again, this tends to be a common phenomenon where investors tend to like large caps and small caps and forget about the middle, which is the whole point of the webcast today.
Okay, good. Next question is, how would you compare the MDY ETF with the IWM ETF, since both focus on mid-cap, and I think that IWM seems to have maybe a higher yield or something than the MDY. I'm not familiar with the
Yeah.
IWM, so I'm not
So I
sure.
believe IWM is the iShares S&P 400. So there should be the same benchmark overall. So they're trying to track the same benchmark. There are some nuances in terms of MDY tracking the S&P 400 and IWM, which tracks um, the S&P 400. MDY does have a longer track record, so it's been around for a while. And it's what we call a unit investment trust. What that means is there's specific rules, very strict rules that it has to follow. So it has to own all 400 securities in the S&P 400. It has to mirror it exactly. IWM does not have to mirror all 400. It has some leeway there overall. In terms of securities lending, we cannot lend securities within MDY overall because it is a unit investment trust. Others can lend overall. So they're the same index. MDY has a longer track record overall, but they are trying to accomplish the same tasks, and there are just some nuances from that perspective.
Okay, good. So the next one's a bit more general, and we'll see if you'd like fancy answering it on how. Is there a bubble forming around AI infrastructure and new energy power plants going in over the next 6 years? And if so, does mid-cap investment the best insurance to go with in light of that risk?
Yes, so that's one of the risks we're concerned with is there is certainly, let's call it bubblicious, I like to say, use as a term within this. Look, I've been around for a while, and there always tends to be a lot of euphoria around new technologies. It doesn't mean those technologies don't come to fruition, but what you pay for an asset absolutely has a direct correlation to what its long-term return will be. And I think a lot of these assets simply are overvalued. The best example I can give you of this was Cisco Systems back in the early 2000s, the early part of 2000. Um, the whole idea around the internet, it was absolutely true. There was a lot of excitement, and there should have been a lot of excitement, and all of it came to fruition. However, Cisco, there was so much excitement around Cisco, it got to a valuation of 200 or 300 times earnings. And while its revenue slowly grew to that, the price at that time simply reflected what the earnings were going to be 20 years from now. And I think that's what you're seeing in AI. So when we call it a bubble, it doesn't mean AI won't be pervasive and have very important implications for all industries. But the price you pay now is reflecting the fact that it's going to grow earnings and earn a lot of money in the future. And so, yeah, I would definitely stay away from companies that have 2, 3, 400 times PE ratios or have no positive cash flow at all, because the prices are fully reflected for perfection for a lot of these. And mid caps absolutely will provide you with some diversification outside of that. Again, the point I just told you, you have to have positive earnings to get into the index to begin with. So some of these companies that are brand new and not making money will not be in the index. So you don't have to worry about some of those crazy valuations for those securities that might reside outside the index.
That's really, really interesting. And I'm afraid as we're approaching, that's all all we've got time for today. A great way to end. Mid caps are definitely a good place to be if you're worried about an AI bubble or bubblicious, as Mike likes to call it. So thank you so much for coming on, Mike. Please, as you leave the event today, a pop-up survey will appear on the screen. Please take a few minutes to let us know what topics you're interested in, hearing about at future events. Thank you very much for joining us, and I look forward to seeing all you in the future. Thanks very much.
Thanks, minimizers. Thanks, Russell. Bye.
Thank you.